On April 20th, 2024, at Bitcoin block 840,000, the moment of the fourth halving that cut block rewards from 6.25 to 3.125 BTC, a new protocol activated on Bitcoin called Runes. Within the first 48 hours, Runes transactions generated over $135 million in fees, more than any other application in Bitcoin's history during a comparable window. The protocol was designed by Casey Rodarmor, the same developer who created Ordinals in 2023, and it was specifically engineered to solve the technical problems that BRC-20 tokens had introduced to Bitcoin. For institutional investors evaluating Bitcoin's long-term viability, Runes represents a structural shift in how Bitcoin's block space economy functions, with direct implications for the security budget that secures the network as block subsidies decline towards zero over the coming decades. Understanding Runes requires understanding the technical architecture choice that distinguishes it from previous attempts at fungible tokens on Bitcoin, and why that architecture choice matters for the network's long-term sustainability. The core architectural distinction between Runes and BRC-20 tokens reveals why Runes captured nearly all institutional and retail attention within weeks of launch. BRC-20 tokens, introduced in March 2023, stored token metadata as JSON inscriptions on individual satoshis using Bitcoin's witness data. This created two persistent problems. Every token transfer required creating new inscriptions, generating hundreds of bytes of chain bloat per transaction, and balance computation required off-chain indexes that had no consensus mechanism. Different BRC-20 indexes occasionally disagreed about token balances, creating ambiguity that institutional accounting could not tolerate. Runes solved both problems through a fundamentally different architecture. Token balances are encoded directly in transaction outputs using Bitcoin's OP_return field, which means tokens are tracked through the same UTXO model that secures Bitcoin itself. There is no inscription bloat because tokens do not require witness data, and balance computation is deterministic because the data lives in standard Bitcoin transaction structures. The reduction in chain bloat, typically 80 to 120 bytes per Runes transaction versus 300 to 600 bytes for BRC-20 transfers, translates directly into lower transaction costs for users and more efficient block space utilization for the entire network. For institutional positions in Bitcoin-native token strategies, the architectural certainty of Runes versus the indexer-dependent ambiguity of BRC-20 is the difference between investable infrastructure and unsuitable risk. The economic implications of Runes for Bitcoin's long-term security model are more consequential than most retail crypto coverage suggests, and institutional analysts focused on Bitcoin's terminal value have begun incorporating Runes-related fee projections into their valuation models. Bitcoin's security budget, the total compensation paid to miners, comes from two sources: the block subsidy that halves every 4 years, and transaction fees paid by users. As the block subsidy declines towards zero over the next century, transaction fees must increase to maintain mining incentives strong enough to secure the network against attack. Before Runes launched in April 2024, transaction fees averaged around 0.3 to 0.5 BTC per block during normal conditions. In the weeks following the Runes launch, average fees exceeded 3 BTC per block, with peak hours seeing fees of 8 to 12 BTC. While fee levels normalized to around 1.8 BTC per block in subsequent months, the structural shift in fee market dynamics has been sustained. For institutional investors thinking about Bitcoin's 10 to 20-year viability, the question of whether transaction fees can grow to replace the declining subsidy is one of the few existential questions about the network. Runes provided the first empirical evidence that organic, application-driven fee demand on Bitcoin can scale to meaningful levels, a critical data point for the security budget thesis. The mechanical operation of a Runes transaction follows 4 distinct phases that together create the protocol's deterministic, UTXO native character. The first phase is etching, which is how a new rune is created on the Bitcoin blockchain. The creator publishes a special transaction containing an OP_return field that specifies the rune's name, formatted in uppercase letters with optional spacer characters like the bullet symbol used in Dog-Air-Geo-Air-Tio Moon, along with the total supply, decimal precision, and optional minting terms that govern who can mint additional tokens and when. The etching transaction permanently registers the rune on Bitcoin and cannot be modified afterward. The second phase is edicts, which are transfer instructions embedded in OP_return data when a rune holder wants to send tokens. Each edict specifies the rune ID, the amount to transfer, and the index of the output that should receive those tokens. The third phase is UTXO assignment, where the protocol attaches the rune balance to specific transaction outputs in exactly the same way that satoshis are attached to UTXOs. This is the architectural property that makes runes fundamentally different from inscription-based tokens. The fourth phase is verification, where indexes parse the OP_return data using deterministic rules defined by the protocol. Because the rules are mechanical and the underlying data lives in standard Bitcoin transaction structures, different indexes will always agree on rune balances. There is no consensus dispute possible between honest implementations. Institutional allocators considering runes exposure must evaluate 4 specific risk categories that distinguish this asset class from standard Bitcoin or Ethereum DeFi positions. The first risk is memecoin volatility. The vast majority of runes that have launched are meme-driven cultural assets with no underlying utility or cash flow. Drawdowns of 80 to 95% from launch peaks are common within the first months of trading, and position sizing must reflect this reality rather than assuming Bitcoin-like price stability. The second risk is liquidity concentration. While over 100,000 runes have been etched since launch, the top 5 runes by volume account for more than 80% of all runes trading activity. Long-tail runes can have order books with bid-ask spreads exceeding 20% and daily volumes under $1,000, making position exit at any meaningful size effectively impossible. The third risk is regulatory ambiguity. The SEC has not provided clear guidance on whether specific runes constitute securities under US law. Runes with named creators, marketing campaigns, and expectations of profit from creator efforts could plausibly meet the Howey test. Institutional positions must account for the possibility that specific runes are reclassified, with implications for custody, reporting, and US investor accessibility. The fourth risk is custody complexity. As of mid-2026, most institutional crypto custodians, including Coinbase Prime, Fidelity Digital Assets, and BitGo, do not yet support runes in their qualified custody products. Institutional positions typically require either self-custody arrangements with specialized Bitcoin wallet infrastructure or partnerships with smaller crypto-native custodians that may not meet institutional security standards. The institutional verdict on Bitcoin runes requires distinguishing between direct exposure to individual runes assets and the indirect implications for core Bitcoin allocations. 4 conclusions emerge from a thorough analysis. First, the architectural superiority of runes over BRC20 is unambiguous. The UTXO native design eliminates the chain bloat and indexer consensus risk that made BRC20 unsuitable for institutional exposure. If institutional capital deploys to Bitcoin native fungible tokens at scale, that deployment will overwhelmingly flow through runes rather than alternative protocols. Second, runes provided meaningful empirical evidence for the post-subsidy security budget thesis that has occupied Bitcoin researchers since the network's earliest days. The sustained fee revenue increase following the runes launch demonstrated that organic, application-driven demand for Bitcoin block space can scale to levels that contribute meaningfully to miner compensation. This is a positive data point for the question of whether Bitcoin can remain secure as block subsidies decline towards zero over the coming century. Third, direct exposure to individual runes should be sized as venture-style speculation rather than core allocation. The memecoin character of most runes, the liquidity concentration, the regulatory ambiguity, and the custody complexity together suggest that runes positions should follow venture capital principles: small position sizes, broad diversification, and acceptance that most positions will go to zero. Fourth, the indirect upside to core Bitcoin allocations from runes-driven fee revenue is real and should be incorporated into long-term Bitcoin valuation models that account for terminal security budget requirements. Bitcoin runes represents one of the most significant protocol developments in Bitcoin's recent history, with implications that extend well beyond the memecoin speculation that dominated initial market attention. The architectural elegance of the UTXO native design, the empirical validation of the fee market thesis, and the structural changes to Bitcoin block space economics all warrant serious institutional analysis. 4 institutional allocators building positions in Bitcoin and the broader digital asset ecosystem. Runes provides both a new asset class to evaluate with appropriate venture-style risk frameworks and an important positive update to the long-term security thesis underlying core Bitcoin allocations. Subscribe to Crypto Mechanics for ongoing institutional research on the protocols, structures, and developments that matter for serious digital asset allocation. We publish weekly analysis covering the specific topics that institutional investors need to evaluate before deploying capital, from Bitcoin infrastructure developments like runes to Ethereum scaling solutions, DeFi protocols, custody infrastructure, regulatory developments, and the evolving institutional crypto stack. Thank you for watching.